Hello everyone, welcome back to X and Yong channel. For investors seeking for capital growth, investing in the US stocks seems more attractive and exciting. Why investing in the US for growth stocks? Two of the largest stock exchanges, the NYSE, New York Stock Exchange, and Nasdaq, are both located in the USA. Firstly, the capital growth is historically proven. The Dow Jones Industrial Average, which is the stock market index that measures the 30 large cap companies publicly listed on the stock exchange, is a reflective of the US overall stock market. Another common stock market index is the Standard & Poor's 500, which consists of the top 500 large cap companies in the US. The S&P 500 gives higher percentage allocation to the companies with larger market capitalization, while the Dow Jones gives higher index weighting to companies with higher stock prices. The S&P 500 represent the top 500 largest market cap companies in the US, while for the Dow Jones, there is no specific guidelines on how the companies is selected in the index. The composition of the Dow Jones and S&P changes regularly. For example, Apple was newly added in the Dow Jones in year 2015. Both indexes consist of some of the most prominent companies in the world, including Boeing, Nike, Coca-Cola, and McDonald's. S&P 500 is widely regarded as the better gauge of the US equity market as it comprises more companies compared to the Dow Jones, which only has 30 companies. For Dow Jones, it has recorded a surge by 900% for the past 30 years. In 2020, Dow Jones recorded 26,000 points. 30 years ago, it was only 2,600. 20 years ago in 2000, the market index is only 11,000, while 10 years ago in year 2010, it was 10,000 points. For S&P 500, the market index is 3,200 points in year 2020. Compared to 30 years ago, in 1990, it was only 322 points. In year 2000, it recorded 1,500 points. In year 2010, it was 1,049 points. It was a huge increment by 200% for the past 10 years. In other words, if you invest $10,000 in the Dow Jones 10 years ago, your capital has grown to become $16,000. If you invest $10,000 in the S&P 500, your portfolio has grown double, become $20,000. Comparing to the FTSE World Global Index, it is noticeable that both Dow Jones and S&P have outperformed the global index. Second, it is the home of the world's most prominent tech companies. Facebook dominates the online social media. Listed in 2012, its price skyrocketed by 500% in just 8 years. Amazon rules the market for e-commerce. Listed in 1997 at $18 per share, its price increased to $3,000 market price now, which is a tremendous increment of 160 times. Apple, listed in 1980 at $22 per share, to the current market price today at more than $400, almost a 20 times of increment. Microsoft, listed in 1986 at $21 per share to $200 today, a 10 times increment. Google, which is the king of internet search, listed in 2004 at $85 per share to today's price at $1,400, an increment by 16 times in 16 years. Thirdly, growth companies usually pay zero or little dividend. This is because companies would like to focus and reinvest all its earnings to accelerate its growth in the future. Companies like Facebook, Amazon, Google, Netflix, and Tesla, they do not pay dividend to its investor. Hence, those are considered purely growth companies. You can only earn when you are selling the company stocks. Apple dividend is only 0.715% and Microsoft is only 1%. The dividend yield is very minimal and negligible. If you invest $1,000 in Apple stock 10 years ago at $35 per share, today, your market value of your portfolio has grown to become more than $12,000. Looking at the dividend, you probably will receive only $80 dividend. After paying the tax at 30%, you only get $56, which is really very minimum. Obviously, investors buying this stock are not aiming for the dividend income. Instead, these companies represent unlimited growth potential. Fourth, high population in the US that share the similar consumerism pattern. US population is currently at 330 million. It is ranked the third most popular country in the world after China and India. A US domestic company can easily expand its business to the other states within US based on the assumption of similar demand. This is how McDonald's has emerged as one of the largest food chains in the world by expanding domestically and internationally. With 19,000 Coca-Cola beverages being consumed every second, 1 million Domino pizzas are being delivered every day, 75 million users visit a Starbucks store every month. These are billion-dollar business models that started small in the US years ago. Fifth, high numbers of global users. The world population is now at 7.5 billion. Facebook users recorded 2.5 billion active users. That means more than 30% of the world population are using Facebook accounts for online networking and social media, which pose a huge revenue opportunity for Facebook. Google has 1.5 billion active users. Businesses are definitely willing to pay advertising in the Google search engine. Take a look into your wallet. Many of us likely to have at least one MasterCard or Visa card. This is a very common practice for e-payment, and using credit card is very convenient for online shopping or paying at the restaurant and supermarket. Within the first quarter of 2020, there were 340 million Visa cards within the US and 800 million outside the US, which totaled up to 1 billion Visa global users, while MasterCard recorded 939 billion cards in the circulation. What about Spotify, a media company that earns its revenue based on subscription basis? It currently has 299 million users with 138 million paying users. As a matter of fact, a company with more users means more customers, which has a high growth potential due to the scalability of the business. That's why most people would prefer to invest in the US stocks for growth potential. If you enjoy our content, give us a like and subscribe to our channels. Thank you for watching and hope you learned something from this.